On July 30, 2025, President Donald Trump announced a full and complete trade deal with South Korea, one that stunned the world. This wasn't a minor update, it was a total overhaul, replacing years of free trade with a new Trumpian model. Instead of the threatened 25% tariff, the U.S. imposed a blanket 15% tariff on all South Korean goods. The era of complex multi-layered free trade agreements appears to be over, replaced by a blunt, transactional pay-to-play system. Market access is now a privilege, bought with massive investments and strategic concessions. The implications stretch far beyond the U.S. and South Korea. This is about power, pressure, and economic survival. Long-standing allies now face the threat of sudden trade showdowns, upending decades of cooperation. This deal isn't just a trade agreement, it's a protection racket, and it's changing the rules for everyone. To grasp the shock of the 2025 deal, look back at KORUS, the U.S.-Korea Free Trade Agreement, launched in 2012. KORUS eliminated nearly all tariffs, hailed as a model for global trade. But Trump called it a job killer, blaming it for America's trade deficit with South Korea. In 2018, he forced a renegotiation. South Korea accepted steel quotas and extended tariffs on pickup trucks. Yet the trade deficit kept growing, and Trump remained unsatisfied. The 2025 deal didn't just revise KORUS, it scrapped its entire philosophy. What began as a symbol of free trade became a target for nationalist protectionism. KORUS was celebrated, then maligned, patched up, and finally discarded. The New Deal replaces cooperation with coercion and free markets with managed trade. It's a dramatic shift from partnership to power play. The old rules are gone, a new era has begun. So what's actually in this full and complete deal? 3 pillars stand out. First, a 15% tariff on all South Korean exports to the U.S., a seismic shift from near-zero tariffs. Second, South Korea must invest $350 billion in the U.S., targeting factories, jobs, and strategic industries like semiconductors and shipbuilding. Third, South Korea pledges to buy $100 billion in American energy, mainly liquefied natural gas. These moves are designed to balance trade, boost U.S. industry, and lock in South Korea as a major energy customer. The message is clear. Access to the U.S. market now comes with a hefty price tag. The relationship has shifted from mutual tariff reduction to a pay-for-access model. It's a transactional approach, prioritizing direct financial commitments over free trade principles. This sets a disruptive precedent for America's future trade deals. The world is watching and recalculating. Why did South Korea accept such tough terms? What could have pushed the country to agree to a deal that seemed so unfavorable at first glance? The answer lies next door, with Japan, South Korea's longtime economic rival and neighbor. Just weeks earlier, the U.S. struck a similar deal with Japan, including a 15% auto tariff and $550 billion in Japanese investments. This agreement sent shockwaves through the region. For South Korea, this was a nightmare scenario. If Japan got a 15% tariff while Korea faced 25%, the competitive gap would be devastating. Korean cars would be crushed in the U.S. market, losing ground to Japanese automakers almost overnight. The fear of losing out to Japan forced Seoul's hand, making the stakes higher than ever before. The Trump administration played the rivals against each other, leveraging their competition to extract better terms for the U.S. This left South Korea with a stark choice: accept the deal or risk economic disaster, with jobs and entire industries on the line. President Lee Jae-myung's government wasn't negotiating in a vacuum. It was reacting to a strategic squeeze, with little room to maneuver. The $350 billion investment and 15% tariff were defensive moves to stay competitive with Japan and to protect South Korea's economic future. In global trade, being the second mover is a position of weakness. The first deal sets the rules for everyone else. South Korea paid a steep price to avoid being checkmated, sacrificing short-term gains for long-term survival. The lesson: in this new era, timing, leverage, and the ability to adapt quickly are everything. The New Deal changes a lot, but some of the toughest issues remain. U.S. tariffs on Korean steel, aluminum, and copper at 50% are still in place, hurting Korean industry. Hopes for relief were dashed. The U.S. steel market remains closed. On agriculture, South Korea held firm: no new access for U.S. beef or rice, a political win for Seoul. But the biggest asymmetry is in tariffs. The U.S. slaps 15% on Korean goods, but American products still enter Korea tariff-free. This creates a one-way street. Fords in Seoul pay no duty, but Hyundais in New York get taxed. The deal codifies America's trade complaints, but tilts the field in its own favor. South Korea defended some interests, but the power imbalance is clear. The U.S. dictated the structure, letting Korea keep a few defensive barriers. The result? A hybrid deal, neither free trade nor balanced protectionism. The $350 billion investment fund is the deal's most contentious feature, and both sides tell very different stories about who will ultimately call the shots. At the heart of the debate is a fundamental question of power and influence, with each country eager to claim victory for its own interests. The U.S. claims it will control the fund, directing investments to align with American priorities and promising that most profits will go to the American people. American officials emphasize that this is about protecting national interests and ensuring that foreign capital serves domestic growth. This narrative sells the deal as a windfall for the U.S. Foreign money, American control. It's a story designed to reassure voters and investors that the U.S. is firmly in the driver's seat, steering the fund for maximum benefit at home. South Korea, meanwhile, insists the fund is for Korean companies to invest in U.S. factories for keeping control and profits in Korean hands. Korean leaders argue that this is a strategic move to expand their global footprint and secure long-term economic gains. The real question: who decides where the money goes and who benefits? Both sides are maneuvering for leverage, each trying to ensure their own companies and workers come out ahead. This isn't a minor detail, it's the heart of the agreement. The answer will determine not just profits, but also jobs, technology, and influence for years to come. The two governments are selling completely different versions to their citizens. Each side is shaping the narrative to fit its own political agenda, fueling confusion and debate. Diplomatic friction is already brewing over these conflicting narratives. Behind closed doors, negotiators are struggling to bridge the gap and avoid a public rift. The truth likely lies in a complex legal structure yet to be revealed. The final details, buried in legal language, could tip the balance one way or the other. For now, the $350 billion question remains: who really controls the cash? Until the fine print is public, both sides will keep spinning their own version of the story. The answer will shape the future of U.S.-Korea economic ties, influencing not just this deal, but the broader relationship for years to come. The deal's impact will hit hardest in autos, semiconductors, and shipbuilding, the pillars of Korea's export economy. These industries have powered Korea's rise for decades, fueling jobs, innovation, and global influence. Now they face a new era of uncertainty and adaptation. For Hyundai and Kia, a 15% tariff means higher prices or lower profits, pushing them to accelerate U.S. manufacturing. Korean automakers must now weigh the costs of exporting against the benefits of building cars closer to American consumers. This shift could reshape where jobs are created and how cars are designed for the U.S. market. In semiconductors, Korean giants like Samsung face higher costs, but U.S. demand is so strong that American buyers may have no choice but to pay. Chips are the backbone of modern electronics, and the U.S. relies heavily on Korean expertise. The stakes are high for both sides. The investment fund targets new chip foundries in the U.S., letting Korean firms bypass tariffs and securing America's tech supply. By building advanced facilities on American soil, Korean companies can stay competitive and help the U.S. reduce its dependence on overseas production. Shipbuilding, once a U.S. strength but now dominated by Korea, could see Korean capital revitalize American shipyards. This could mean new jobs, about technology transfer, and a rebirth of an industry that once defined American industrial might. For Korea, investing in U.S. industry is a way to maintain access and build goodwill. It's also a strategic move to ensure long-term partnerships and influence in a critical market. The old model, exporting from Korea, is being replaced by producing inside the U.S. This marks a fundamental shift in how Korean companies operate globally, and it's happening fast. The 15% tariff is the stick, the investment framework is the carrot. Together, they're reshaping the rules of trade and investment between two economic powerhouses. Korean industry must pivot from exporter to investor. The landscape has changed permanently. Companies that adapt quickly will thrive, while others risk being left behind. This is more than a trade deal. It's a forced industrial transformation. The ripple effects will be felt across supply chains, workforces, and boardrooms on both sides of the Pacific. The world's supply chains will never be the same. As Korea and the US rewrite the rules, the rest of the globe is watching and preparing for change. Even before this showdown, US-Korea trade was rocky. The 2022 Inflation Reduction Act gave tax credits only to EVs assembled in North America, excluding Korean models like Hyundai's Ioniq 5. Korean automakers lost a key price advantage, and Seoul protested the move as unfair and discriminatory. This episode showed Korea that the US would prioritize domestic industry, even at allies' expense. The lesson: America First wasn't just a slogan, and the threat of tariffs was real. These tensions shaped Korea's approach to the 2025 deal. The EV subsidy fight and steel tariffs left deep mistrust. Even with a new deal, the relationship is built on cracks of past grievances. The foundation is shaky, and both sides know it. The July 30th announcement is just the beginning of a new, uncertain chapter. In Korea, investors breathed a sigh of relief, but protests erupted over the deal's harsh terms. President Lee Jae-myung's upcoming visit to Washington will be crucial. He must sell the deal at home, while Trump claims victory for American workers. The real test is implementation. How will the 15% tariff work, and who controls the investment fund? If the U.S. pushes for total control, expect more diplomatic clashes. This deal sets a precedent. Access to the U.S. market now comes with a price. Other countries are watching, wondering if they're next. The only certainty: global trade just got a lot more unpredictable.